Really pleased to see a positive growth number in this quarter. As we've said to the market a number of times, given GSR is July, we're not sure which quarter these numbers are going to pop. Confident they will, but really pleased to see a reasonable level of growth given the regulatory tailwinds that are occurring.
Hello, you're watching Proactive. I'm joined by Seeing Machines CEO Paul McGlone. Paul, very good to speak with you. KPIs were released yesterday announcing automotive royalties or cars on road, as well as aftermarket momentum with Guardian hardware sales across the second quarter of 2026. Can you give us your view on the results generally, please?
Thanks, Stephen. Yes, we released our KPIs, and our view is that they represent strong momentum, both in automotive on the royalty side and both in Guardian hardware sales. And then the addition to that is the underlying annual recurring revenue that's really important to our business model in the long term. We're starting to finally see an uptick in that metric, which I think the direction of recurring revenue. So that's the first point. In terms of royalties, really pleased to see a positive growth number in this quarter. As we've said to the market a number of times, given GSR is July, we're not sure which quarter these numbers are going to pop. Confident they will, but really pleased to see a reasonable level of growth given the regulatory tailwinds that are occurring. And with the GSR drop dead date, July 26, very well locked in. All of the OEMs now are finalising how they're going to manage compliance at that particular date. So there's a lot of moving parts, a lot of unknowns still about exactly when volumes are going to make that real step change, as they must. But again, very confident. So while the timing of the steep ramp may be in the first quarter of the calendar year or the second quarter of the calendar year, as we've said many times, we are confident and expect that uplift to occur. So pretty pleased with the quarter's results, and also it leads us to quite a confident feel for the next two quarters.
Paul, in auto specifically, the announcement mentioned RFQ delays. Could you please explain what you mean here?
Yeah, look, we mentioned RFQs not because they're really relevant to the KPIs on a quarterly basis, because that's about production, but because there are a lot of questions all the time about RFQs. And the reality is RFQs across the entire market have been delayed. And I think everyone can see the turmoil that car companies around the world are facing. And that's having a direct impact on decisions. And typically those decisions are to wait and see or delay in some way. That's certainly the impact on our sort of very narrow niche within the segment. So that's a fact. Now, the RFQs that we are working on, there are numerous and they're significant, as they have been for some time. But we need to remember that the majority of those won't hit production until 2028. So it's kind of the canary in the coal mine. It's an early KPI. We felt it important to mention. It's got nothing to do with cash or cash flow in the next quarter, or in fact the next 24 months, other than NRE. But we felt it important to mention.
Does this have an impact on what we can expect to see in terms of GSR compliance?
This is a really important question, and the short answer to that is no. As I said, the RFQs that we're working on today, there's a 2 to 3 year time frame for the integration of software within the vehicle, and so revenues for current RFQs are 28 at best. So all of the effort that is required to get systems into passenger vehicles that are sold in Europe for GSR, July 2026, that work has already been done. So that's a really important point. And we're seeing more and more confidence and actual extensions of lines within our existing customers in order to meet the GSR requirements. So one really important fact is that no matter what the RFQ situation is today, that has absolutely no impact on those that either are European manufacturers that sell in Europe or international manufacturers that sell in Europe. That has absolutely no impact on their ability to meet GSR come July 26. That work has already been done.
Guaranteed volumes were mentioned again, and this can be a complex concept. Can you clearly explain what these arrangements mean?
Yeah, and again, this is one of those things that we get continuous questions on, as weeks go by, and so we felt it important to mention again within the context of the KPIs. But I think it's really important that we try and explain this in a way that's really pragmatic. So the agreements for which we have minimum guarantees are related to a specific customer. Now, we've mentioned before that accounts for about $53 million of our $400 million of one business. So it's an important proportion of that total business, and it's quite unique, that's for sure. So the value of these quarterly payments ramps up over time to match the expected ramp up of new programs. So what that means is that when we negotiated those arrangements, we negotiated a fixed ramp up of volume, regardless what the actual volume looks like. And this is a really beneficial outcome for us. So what it means that if a program is behind on volume for whatever reason, in ramp up that often happens, regardless the reason, we can rely on the fact that we will get paid for the minimum agreed volume. So that's really important. As we move through the life cycle of that contract, beyond the start of production and ramp up into the steady state, well, we continue to receive royalties, but we'll receive, at worst, the minimum guaranteed volume. And if volume increases above that level, we will receive the higher amount. So essentially, it sets a floor on the revenue that we'll receive, as opposed to the volume that we report. Now, I think what's really important here is that the actual volumes from these programs where we have these guarantees are around sort of 15% of our Q2 volume that we've just reported. And our expectation is that will continue. Now, what we know as we look at Q3, the majority of the volume that we quoted in Q2, almost 580,000 units, the majority of that is covered by the increasing minimum volume guarantees in Q3. So this is one of the things that gives us a high degree of confidence, certainly in the revenue side of that equation going forward. Now, the other thing that we mentioned in terms of our position in the quarter against the guarantee. So in Q2, actual volumes were in excess of the guarantees. And that's the position that we want to see going forward, frankly. But year to date, they were still below the original expectation. So the guarantee has provided us a level of support in terms of cash payments at that minimum level. But as we've seen in this quarter just gone, we're now starting to see volume above the guarantees, which is what we always expected. So it all augurs very well for Q3 and Q4.
What was the real benefits of having these guarantees in place, Paul?
Well, the real benefit is around cash as opposed. So what we report in the KPIs is volume of cars shipped, and we call it cars on road, because we think that's a really important, basic, underlying metric that shows the performance of the business. But the volume guarantees are something different. That's about confidence around revenue, regardless the volume. And if the volume produced is higher, obviously we get the higher number. But if it's lower, we get the floor. And so for us, from a cash point of view, that's very important. Now, if you were to take that on a sort of notional basis, i.e., what do these guarantees represent in a quarter where they are higher than actual production, you could probably say that notional volume is higher than the volume that we reported. But we don't get into any of that. We're just very straightforward on the way we report actual volume shipped, but the guarantees provide us a level of cash that is underpinned by the contract, and that could be higher than the volume shift.
How do these guarantees affect the cars on road figure?
Yeah, so the cars on road figure that we report, as I say, we're trying to just get a very basic, practical, single metric that people can understand. So that number, the way we report it transparently, is when we ship the software into a vehicle, that's the number we report. Now, in that quarter, if the guarantee is higher than the volume shipped, we would get paid the cash amount for that. But in the reported volume, we're only reporting physical shipments. And we think it's very important that we continue to do that because that's a representation of the underlying performance. And the other thing is we're really confident that underlying performance will outpace the guarantees, certainly as we move closer to GSR. So that's really, really important.
Paul, you noted being ahead for the quarter, but cumulatively behind. Can you explain that?
Each of the last couple of quarters prior to Q2, we were behind. So we were enjoying the benefit of cash payments that were higher than the physical shipments of software into the vehicle. But in Q2, this was the first quarter under these arrangements where volume was actually higher than the minimum guarantees. Now, this is also a really important data point, and I think critically important to the story around momentum is that we're starting now to see the increase in programs across the board. So, yeah, that's how I'd explain that.
So, Paul, you're up with your first half trading update next week, and we'll be chatting about that then. Before that, any closing comments?
Well, I think based on the quarter just passed, we remain confident in Q3 and Q4. If we look at Automotive Royalties, those things the data points I've just mentioned around guarantees and overperforming against the guarantees, the data points around the fact that there aren't any RFQs that are going to displace current volume. So incumbency is a really important factor for GSR because existing OEMs will have to draw on the incumbent providers for this volume. That's extremely positive and gives us great confidence. So the medium-term outlook next 2 quarters, we're very, very positive. Yes, we've got our update next week on H1 results. Of course, that's a rearview mirror view of the world, but our intention at that point is to obviously cover those numbers and show the improving trend in those numbers, but more importantly, talk about our expectations for the second half and the full year, which we are still feeling very positive about in terms of a cash flow break even Q3 and profitability for the second half.
I'll look forward to chatting with you again next week then. Thank you very much for the update today.
Thanks, Stephen. Appreciate it.
Paul McGlone, the CEO of Seeing Machines.